Hi, this is Jeffrey Cohen, Chicago Quantum, here to talk about our down run. This is where we pick stocks using our quantum algorithm that are expected to fall. Stocks that are expected to drop relative to the S&P 500, especially during times of market turbulence. So recently we've had a situation where the S&P 500, peaked. And so earlier in July, 35 trading days ago, we picked 20 stocks, and if you held them equally, 5% in each of the 20 stocks, we thought for sure that they would fall versus the market. So we call them our dog stars. We called it our down run. These are the stocks that you would short versus, being long the S&P 500 or the SPDR, the SPY ETF. So we're going to walk through it. I'm going to give you the answer first. The answer is, if you would have invested and you would have shorted these 20 stocks, you'd have made a lot of money. How much money? You'd have made an extra 17.5% on your money versus the S&P 500. And so they fell more. So actually the way you'd compare it is shorting the S&P 500 or shorting SPDR versus shorting the 20 stocks. So if you would have done that, you would have been up 17.5%. And in fact, when you look at the stocks, trying to make it so you can see, you see what's in white here are the stocks that outperformed the S&P, meaning they dropped 18 of the 20. So this is after 15 days. This is August 2nd. So July 9th, close versus August 2nd, I think that was like morning, you'd have done great. You'd have made 11% shorting this versus shorting the S&P if you thought the market was going to drop. And in fact, you had some real zingers in here. You had Marin Software that dropped 52%. You have B Squared that dropped 33%. You just had a bunch of dogs, right? You had two stocks that you would have bet wrong on. So now you go out 35 trading days. Now this blows my mind because we're dealing with 253 trading days of data. The way I describe this, it's like if you took a ball. This is a NFL football signed by Drew Pearson. Love this. Okay, if you take a ball and you would throw it, what the model does is it continues the trajectory of the ball. Makes sense. If they're dogs, they're going to be dogs for another 1% of the time, 2% of the time, 10% of the time. And so in our model, we've always assumed 10%, meaning 25.3 trading days. Well, guess what? This is 35 trading days. So, it's one data point, but it's a pretty robust data point looking at, 4,600 stocks, picking the 20 worst, most inefficient stocks, and putting them out there for you. So just to walk through, now you got Marin is down 60%. B Squared is down 42%. But you got some others here, 39, 38, 24%. Just so fascinating. And when we look into these stocks, generally from a fundamentals perspective, we're really glad we don't own them. And so how do we do it, right? How do we pick a bunch of stocks that, we think we're going to fall, and then they fall? So let's walk into the little PowerPoint slide I put together to walk you through the logic. So our down run, first and foremost, right, it looks for stocks with daily price volatility that outweighs the expected returns. I'll slow that one down a bit here. By the way, Captain America. For any of y'all that love America. We do. So here's the way I look at it, right? If you're an investor, if you're a widow and orphan, okay? If you're a conservative investor, if you're like a normal person on the street, you don't want to wake up one day and find out that your stock moved 25% in a day. And let's be honest, if it went up 25%, you'd be happy. But if it fell 25%, you'd be more unhappy. I just know that about people. They lose sleep thinking about that the stocks are going to crash, that the money that they worked their whole life to save is gone. And so they'd like the upside, but they sure would like to avoid the downside. And so what we're looking for is we're looking for stocks that might have really great expected returns, but they have tremendous daily price volatility that outweighs it. And we use a quantum algorithm to find these stocks. Quantum algorithm because you can't just do regular math on a quantum computer. It doesn't do division and it doesn't do multiplication. So all of your ratios, right? Price earnings ratio doesn't work. You have to change the whole way you think about picking stocks to do addition and subtraction only. We did that, took about 9 months, built a model. I mean, to be honest, right? More cowbell. Model's been making good money for people. It's a good model. It works. And then here's another case. And what we do is we document this on Medium. Usually we document it the day we start the experiment so that there's no funny business. You're seeing stuff as it's happening. So the second thing we do is we use 253 trading days of stock data. It's 1 year. And that includes closing prices, volume, and dividends. So it's not just looking at prices. We look at volume. We look at dividends. We look at the actual prices. We look at beta. We look at beta and we don't like negative beta. We think it's an anomaly. So we handle it in our model. These are not negative beta stocks. They actually get removed. We then select the portfolios. So portfolio, modern portfolio theory, MPT, says that you should look at stocks in the aggregate, how they act with each other. We do that. We look for zigs and zags. For paying clients, we select those stock portfolios with the absolute worst or most inefficient portfolio scores. It's awesome. Just imagine we're able to look through a search space of a quintillion stock combinations. And we find the worst one that we can. Now, we use a quantum algorithm sometimes. I mean, we always use a quantum algorithm. Sometimes we actually use a real quantum computer. When the client prefers that, we do that. It costs us more money, though. We got our Dell server over here. It takes about 6 hours. It's great, though. For others, for public consumption, and by the way, this could work for a client as well, because some clients don't want to pick just those stocks that we tell them. Just give me the 20 worst. And I'll diversify out my risk and I'll invest 5% in all 20 and I'll short them all. So we take the 20 worst individually scored stocks and we give them to the client. Okay, that's really cool. So now you get a choice. Sometimes you only want to do 10% and 10, right? I want to avoid trading costs. Whatever. I like it because it's a diversification play here. I believe it's very important to diversify away specific risk. I don't always do that for my own portfolio, but for clients, absolutely. We then track the actual performance and we publish it publicly. We track performance for 15 days and 35 trading days versus the index. And we talked a little bit about this before, but we include stocks that pass rigorous data validation standards. So in fact, of the 4,600 stocks that we start with that are listed on U.S. exchanges, New York Stock Exchange, NYSE American, the NASDAQ Capital Market, the NASDAQ Global Market, and the NASDAQ Global Select, we throw out 1,000. Either they're missing data, they get negative beta, the stock price is too low, stock price is too high, whatever. Crazy stuff, right? We don't like that data because it feels like it's dirty data. So what happened? Well, I'll show you the list of stocks here. Not that interesting. But what you see here is you see, let's see if I can get you the capitalization. Price to book ratio ranges from negative a quarter to 14. So we're not just picking high price to book. Let's look at forward price to earnings. You got some negatives. You got a 6.8. You got some 3.33. And then, you got a couple that are higher, like 39 or negative 129. So this isn't just picking PE ratios. Let's look at the market cap. I mean, you're pretty... Let me get here. Yeah. You got one that's over $1 billion. You got a whole bunch that are over like 200 million, and the rest are small cap. So what does that tell you? The first thing that tells you is if you're going to invest in a small cap stock, you're probably going to have more price volatility. And that's because a group of concerned citizens who decide to buy the stock, let's say they all read the same research article, and they all independently, without talking to each other, buy 10,000 shares. Well, it's going to move the stock a lot, right? Or if one institutional investor decides they want to put $1 million to work, that's going to move the stock. Versus $100 billion or $1 trillion stock, it's really hard to move. So first thing I would say is, yeah, there's some insight here about small cap versus large cap. Small cap's got more risk. We know that. That's okay. What else can I look at here? Oh, I guess another thing to say is we do not have a position in any of the stocks. We do have a position in the S&P 500. We do have some passive index funds. That's fine. We don't control the S&P 500, but we do not have a position at all in any of those 20 stocks. I mean, they do go up and they do go down, right? Like today, RHE is a REIT. It's up 7% today. GBR, which is not an energy company, by the way. They're a real estate holding company. That's weird. In a small city in West Virginia. They got one building, one complex of buildings. It's up almost 10%. Now, in part, that could just be some meme-type excitement. It's fine. Not going to say that these don't go up and down. Of course they do. They're high volatility. But they over time, they're going down a lot relative to the market. So now I want to walk you through the report that we did. Now, instead of doing this for a client, we did this for you. It's kind of fun, right? I get to write a report and I get to give it to you, the listeners, or the readers, right? So this is on Medium. You go to Chicago Quantum and you take a look. All right, see, what's fun is I pinned the report that went up. So we also pick stocks that go up. And we picked this one, and your alpha return was 13% after 24 trading days. If you would have bought these 10 stocks, so a little less diversification, you'd have made 17% versus 4% for the S&P. That's nice. So, yeah, we know how to pick stocks that go up. The question is, do we know how to pick stocks that go down? That was the question that was asked. And the answer is, yeah, we do. So, top 20 inefficient stocks picked by the Chicago Quantum Net Score, that's our quantum algorithm, with 15 or 35 trading day results. Summary results. If you would have shorted the 20 stocks, and I realize, so thank you for being patient with me, if you would have shorted them versus shorting that same amount of the S&P 500, you would have made that extra money. I said it wrong when we started the call there, I realize. And including dividends, of course. So when we updated it for August 2nd and August 30th, both at market open, and then the spoiler alert is, wow, the model picked stocks fell much faster than the S&P 500. We call this our inefficient stock picker. It's actually funny. Once I published a job posting, sometimes we're looking for people for a quantum stock picker, and I had a warehouse manager apply. So we're inefficient stock pickers, down run or dogstar run. Okay, so what we did for 15 trading days, it was 11%. So the stocks fell almost 10%. S&P was up 1. So that's the difference here. It was down 14%. S&P was up 3.5%. So in fact, it was a tumultuous time in the market, but in fact, the S&P went up. Your stock still went down. So you would have basically gone into these stocks thinking, oh, the Federal Reserve and COVID and all these problems, Afghanistan, and the market's too frothy. Jeff, give me something to short. Give me something to drop. Okay? Here it is. You drop these 20 stocks. You short them. Short them to the moon and back. You would have made 17.5%. So a few things mattered to us. A few things caught our eye. Okay? And one of them is very few of the dogstar stocks actually rose at all. It's weird. They just fell. 2 or maybe 3 of them rose. Especially compared to the S&P 500. The declines were stunning. 5 stocks fell more than 20% in 35 trading days, and the largest decline was 60%. In fact, that largest decliner, down 60%, is down like another 6 or 7% today. It's crazy. It could go to 0. Some of the stocks fall during the first 15 trading days and then maintain their decline. Others continue to fall, and 5 stocks actually fell and then rose. So 75% either stayed flat or continued falling after the first 15 days. That means the market, these stocks are consistent in the market. 75% of them, when they fall, they either stay flat or they keep falling. Only 5% started to reverse the trend. So they're interesting results for us because they show a quantum algorithm that can select stocks that should be avoided or shorted by investors. I mean, you guys know, we started our business picking stocks that you'd want to invest in, that you'd want to put your hard-earned money in and sleep at night. But we had a client that says, Jeff, give me stocks that aren't going to go up. Give me stocks that are going to go down. Especially if I'm uncomfortable with the market and I think the market's too high. Give me a way to really make a profit on the way down as well as on the way up. And so I think what's important, here's the list of the stocks. I mean, you can read the report, right? The first thing I want to do, though, is I want to talk to you about the disclaimer. So I, Jeff Cohen, am the president of the company. I wrote the article myself. I didn't receive any compensation for this. I do not get compensation from YouTube. Maybe I make 5 cents from Medium, an average of $1 a month on Medium. We don't get any compensation from our website. We get compensation when you as a client say, Jeff, run a job for me. Help me to find the stocks that are going to go up or going to go down. Either here's the list that I want you to analyze or just run them all. The second thing is this is not investment advice. This is not for everyone. You have to do your due diligence and research before investing. See, we do this for a living as a fee base for our clients. We have not had a position in any of the stocks mentioned in this article for the past 4 weeks, nor do we intend to initiate a position in the next 4 weeks. There's no conflict of interest. There's no pump and dump here. And our disclaimer, which was true when we published the article in July, is still true. We've never had a position in any of those stocks since we wrote the article. We still do not have a position. And by the way, we have never shorted a share of stock in our life. So I want to thank you for listening. This is Jeffrey Cohen. And again, as a reminder, right, we are an Illinois-based investment advisory firm. So if you live in Illinois, you manage money in Illinois, you spend a lot of time in Illinois, love to do business with you. Now, we also do quantum computing consulting, and that you could be anywhere, global, no worries. We're an Illinois management consultancy, and we're actually working. The Series 65 test is on Friday of this week. I'm a little nervous, but we're going for investment advisory registration for Illinois. So it's pretty exciting. And the way we get paid is you can buy an analysis, right? So Jeff, pick me a long or an efficient portfolio. Either here's my stock tickers, or just run the whole thing, run all the exchanges or some exchanges. Or give me your short or inefficient portfolios, and same thing. Do it for certain stocks or do it for the whole exchange, or whole sets of exchanges. And then some people, they'd rather just buy time. Let's sit down, let's have a strategy workshop, let's do some consulting for a day. I show up or some of my team shows up. Or you could buy an hour for $250, just let's get to know each other. So this is how we make money. I thank you if you decide to become a client. I can't guarantee performance. Past performance is not indicative of future performance. But for us, I love it. I love it when we build a model and it works. I'm so proud. So thank you very much, and good luck in the markets today. Good luck. Bye-bye now.